Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 255 of the Independent Advisors Podcast, where Mark McEvily and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, I am blessed to have Nick Whitaker on the podcast with us. Welcome, Nick.
Always good to be here.
Nick is our firm's Director of Research and Trading, jack of all trades.
Master of none.
Matt, that's not accurate. And so as we, I love that. So before we begin, Nick, I'm going to turn it over to you and have you do our pricing. We review month and year to date performance of the major indices we track. And correct me if I'm wrong, this data is from Y Charts as of market close on June 5th of 2024, correct?
Yes, that is correct. So the S&P 500 is up 1.5% month to date, up 12.2% year to date. The Dow Jones is up 0.3% month to date, 3% year to date. The Nasdaq is up 2.7% month to date, 14.5% year to date. The iShares Russell 2000 ETF, think small caps, is down 0.3% month to date and up 2.2% year to date. The Vanguard FTSE All World ex-US ETF is up 0.8% month to date and up 6.8% year to date. Our yields, the 3-month Treasury rate sitting at 5.51, the 2-year Treasury is sitting at 4.72, and the 10-year Treasury rate is currently at 4.29%.
Thank you, Nick. It's interesting to kind of see that difference between the Dow and the other two stock indices, domestically, the S&P and NASDAQ, which is why I have a very timely piece later in the podcast, really discussing the makeup differences on the methodology of how the S&P is made up and how the numbers work between them and the Dow. And I think our listeners and viewers are going to find that very enlightening.
Yeah, I think it's very, very timely given the differences in the indices. Right now.
Year to date, right? One's up low single digits, the others are up low double digits. Mm-hmm. Let's pivot. Big headlines and current events. I'm going to let you begin on this one, Nick.
Yeah, so two major things here. The PCE price index came out last Friday on the 31st of May. So think the Fed's preferred measure of inflation. So a big print. The index was up 0.3% month over month, in line with expectations, 2.7 year over year. The core PCE index was up 0.2% month over month and up 2.8% year over year, unchanged from March. The key takeaway from the report is that year over year, the inflation didn't worsen. That said, it didn't improve either, right? So I think the market's going to view it as unlikely that the Fed would find any new confidence in this report, that inflation's moving substantially towards that 2%, which is the main concern there. Is you want, and we've talked about in the past, getting from 3 to 2 is the hardest piece, and so we need to kind of see that data continuously pushing down. When we see a kind of stale, or I should say stagnant report, and that's not going to give the Fed any encouragement to cut rates sooner than expected. So just a bit of the status quo there from the PCE report.
One quick comment on inflation. Mark said this last week, and I will remind listeners and viewers in case they didn't tune in last week. Mark reminded, hey, over the summer, the year-over-year comparables on the inflation data is going to be tough, because that inflation started to moderate last year. And so you might see some data that's, well, year over year, it's up this much. Mark was pointing out, hey, you got some tough comparisons, some tough comps coming this summer, and you got to look past that. And so that's just something to stay mindful of.
An excellent point. Yeah. It takes longer too to get that 3 to 2%. So and that gets back to and that gets back to the comps that Mark pointed out. So that's an excellent point. Yeah. The other thing just to keep in mind that I have is the jobs report for May comes out tomorrow. So you could see some volatility in the market around that. We're at the point in the market cycle where we actually want to see a bit of a weaker report. So we'll see what happens.
My 2 cents there is if these job openings numbers continue to come down, I think you are going to see the employment numbers follow. So we'll see if
Hmm.
that tends to be the case.
Yeah.
I got two bits of news on the big headlines and current events.
Yeah.
This first one gets me excited.
Yeah.
Okay.
This one's cool.
This one's cool. So, investors are raising money to launch a new stock exchange called the Texas Stock Exchange, or the TXSE. Their website says it's going to be a fully electronic national securities exchange that will seek registration with the SEC. They're aiming to start trading in 2025 and host listings in 2026. It's going to be physically domiciled in Dallas. I think this is great. I love capitalism. Competition is good. And at the end of the day, the NASDAQ and the NYSE have had a little bit of a quasi monopoly, right?
Oh, of
And
course. Yeah.
they're going to start to get some competition now for listings. And one thing I hope happens is I hope the Texas Exchange is open to listing smaller size companies. So we can have a lot more IPOs of smaller size companies. We'll see if it happens. But I think that this is a good thing for the markets. Your thoughts, Nick?
I think it's a great thing for the markets. Like you said, competition is a good thing. That's the whole point of capitalism, right? With competition, you get the best results.
Got to sharpen your
So
sword.
yeah, I think it's a great thing. I do think it'll be interesting, Texas has in the past had electric grid issues, so
Ah,
that'll be an interesting wrinkle to think about. They have less issues in New York just because of the environment, quite literally the heat. So that'll be something that, they'll have to, 10, 20 years down the road will be interesting to see how the
good point.
competition moves based on the electric grid. But I'm thinking that's, like I said, that's 10, 20 years down the road as the grid
Valid point.
gets more built out. And I think there might be slightly better places to put a competitor. But from a capitalist perspective, I think Texas is a wonderful place to put it. Get away from
East
uh,
Coast.
the East Coast a little bit, kind of.
Yeah,
So yeah,
I
I
think
think
it's
it's
great.
great.
So the last thing I have on big headlines and current events, and I want to see what your response is. This is not going to be surprising to you, but the magnitude in time period, I think, will. So here we go, listeners and viewers. Over the past 32 days, this is something I saw this morning, so it is obviously June 6th. Over the past 32 trading days, Nvidia has gained more than $1 trillion in market cap. To put that into some sort of perspective, this 6 week gain is greater than the total market cap of Berkshire Hathaway, which is Warren Buffett's company he founded. And he spent 6 decades building that company.
Yeah.
This is not a recommendation for or against either of those names, but rather to put into perspective the optimism, euphoria in the potential of AI. Nick, your comments.
Yeah, I saw a lot of charts and a lot of news on this.
It's
It's
heavy. It's heavy.
it's pretty incredible. It's a pretty incredible run. $3 trillion company now. One of the reasons for that difference in the Dow and the S&P and the Nasdaq is Nvidia. The weighted. I saw a chart yesterday. The weighted percent gain year to date. Again, the weighted, not just what Nvidia individually has gained, which is 160% or something like that. But the weighted gain is 32%, which is leaps and bounds, I don't know, 25% more than the next stock. It's eh, I hardly even know what to say. I'm a bit flabbergasted by it. It
I mean,
is
this is a monumental stat to think about.
it's
32 trading days, $1 trillion.
yeah, this is pretty typical of the street though. When you look back at history, whenever you have a new thematic investing opportunity like AI, You see a lot of people getting in because, when you look back 20 years ago, or, when you get 20 years down the road and you look back at today, what's it going to look like? And so that's why I think there's, buying the leading player, and there's a lot of demand for the leading player because historically barriers to entry in certain markets are more difficult. So
Yep.
there's a handful of names that you want to get in on the ground floor when you think about the AI story. So there's going to be volatility with this space is the biggest thing I would tell the listeners is, when you see these headlines and you're reading the Wall Street Journal and it's like, oh, Nvidia, um, you know, be prepared for the volatility. There's
Absolutely.
gonna be swings in the
It
AI
doesn't go one
space.
way. And trust me,
It,
sometimes you're taking the escalator up and the elevator down. In this sense, you're taking the elevator up. I don't know what the other side was going to look like.
yeah, if we did, then we could predict the future, which would be amazing. But I can say that with confidence, there will be volatility in the AI trade and Nvidia and chips over the next few years, likely even over the next few months. Just anytime you see a swing like this, expect some chop at least.
Oh, yeah. One last thought. And again, these are not recommendations for or against individual securities in the podcast. I read something recently that a lot of the IP or intellectual property that Nvidia has that's giving them such a competitive advantage in this space was via an acquisition they made about a decade ago, and they spent less than 2 billion on it. And it's just amazing to see what that's turned into for them. So some of
Mhm.
these smaller acquisitions by these tech companies, they're trying to hit some home runs, and they're just going up to bat, hitting grand slams one after the other.
Mhm.
All right, let's transition to tweets, articles, and research from this week. Mr. Whitaker, I'm going to let you begin.
Yeah, the first thing I have is it's a Bloomberg article that was popping up on my phone, and I was getting Bloomberg alerts yesterday. It's just an interesting one. Goldman, the article's titled Goldman sees wall of money fueling stock market's summer party.
I picked the
Um,
same piece for later in the podcast. I swear to you.
did you really? Okay.
Yes,
Well, sorry about that.
I
Stole
think it's
it.
great. Hey, just listeners and
So
viewers know they know this for our regular listeners that we don't compare notes ahead of time on purpose. This is awesome.
we do not. We do not. So I'll read a few
Yeah,
pieces
please. I think this is
here.
enlightening, and I want them to hear this.
A flood of cash from passive equity allocations will pour into the stock market in early June, setting up a continuing rally through the early summer, according to Goldman Sachs trading desk. New quarter and new half year. This is when a wall of money comes into the equity market quickly. This is from Scott Ruber, Goldman's Global Markets Division Managing Director and Tactical Specialist. Boy, that's quite a title.
That is quite a title.
So he wrote this in a note to clients. He said, in addition, share prices should benefit from strong seasonal trends and rising engagement from retail investors. Quote, I am seeing a reemergence in retail traders during the summer. They tend to come in around July. Uh, Based on Ruber's calculations, roughly 9 basis points of new capital gets put to work every July. For this year, that would be 26 billion based on the 29 trillion in passive assets available for investment. Um, so yeah, that's the call from Goldman. He thinks there's going to be some. Scott Ruber thinks there's going to be some capital inflows this summer, which could help prop up the markets. In what is traditionally kind of a choppy time of the year, where
Yeah, because what
it's kind of
happens
moves
is,
sideways in the summer. Volumes go
trading
down.
volumes tend to dry up a little bit over the summer. A lot of the heavy hitters from Wall Street, they tend to be
They're out in the
vacationing
they're in the
over the
Hamptons.
summer.
Yeah.
You've heard me say on the podcast pretty regularly the last several years, volumes tend to go up after Labor Day when Wall Street executives return to more of a full-time schedule. Um, wouldn't surprise me. And again, I think there is still a large number of investors out there, Mark, who might be under allocated to stocks or risk assets. So
Mhm.
my words of wisdom is this is not a market that you want to try to time. You want to continue, if you want to increase that exposure, come up with a strategy of dollar cost averaging over a certain
Yeah.
period of time. Don't try to time this sucker. And if you get a larger pullback, maybe you make that dollar cost average frequency quicker. So instead of 6
Yeah.
months, we get a correction of 5 or 10%. Maybe you make it over 3.
Yeah. Scale it.
Words of wisdom. Words of wisdom.
My next piece is on the ISM Manufacturing PMI Data. This is a post actually from Charlie Bolello, whose research we obviously love.
Yeah, good stuff.
This came yesterday. The ISM Manufacturing PMI has been below 50 in contraction for 18 out of the last 19 months. The last time this happened, 2000 to 2002. Just a quick note on what is the ISM Manufacturing PMI. ISM is Institute for Supply Management. The PMI is the Purchasing Managers Index. So, in a nutshell, it's based on data compiled from purchasing and supply executives nationwide. They review new orders, backlog orders, new export orders, imports, production, supply deliveries, inventories, et cetera, et cetera, et cetera. Lots of things in the supply chain, right? They basically take that, they look at changes between that, look at the positives, look at the negatives, and they build an index out of it. So a PMI reading above 50 indicates that the manufacturing economy is generally expanding. Below 50 indicates that it is generally declining or in contraction.
Correct.
So again, going back to what Charlie was saying is, hey, we've been in contraction for 18 out of the last 19 months. The last time this happened was early 2000s. And what we have a chart here that we can
Yeah,
throw
we'll
up.
put up Jenna will put up for our YouTube viewers. Will be in our show notes and all of our social media sites.
And I don't point this out to scare or spook anyone, more just to give them the information. I feel like I do this in a lot of my podcasts where I give you the really bullish side and then I give you the the bearish side and then try to talk you to the middle. So this is obviously a negative data point, but
Yep.
it's a negative data point for the economy. But again, that's kind of what we want to be seeing to some degree with where we are in the market, right? Like what we talked about with the jobs report, where hey, we want the jobs report to start coming in, unemployment maybe to tick up a little bit, as bad as that sounds. But that's what we want in healthy markets so that we can ensure that the
We don't
rates that have
overheat.
been exactly to ensure we don't overheat and cause even bigger swings in the market. Because when you overheat, you're going to cause bigger swings in the market, which is more painful for investing.
I'd argue, and this is one of the challenges I think of the Fed. If it weren't for demographics and it weren't for what's happening with baby boomers continuing to retire, I think the jobs market would be a lot worse. But what's happening is because of demographics, and you continue to have a large amount of retirements, that is making the jobs numbers not look as bad. Because as those people retire, it's retaining other jobs. They're having to hire to replace that person.
Yeah.
I'd argue that if this demographic were happening 15, 20 years ago, the jobs numbers would look a lot worse.
That's an excellent point. It's an excellent point. I completely agree.
One quick tidbit for you to go to the next point. Before my father retired in the 2000s, he wasn't one of those individuals that would reply to these ISM surveys. Believe it or not, he was an
Oh,
executive,
okay.
and he would do one of
Nice.
the.
That's
He would
cool.
do that on a regular basis.
Yeah. I've never met
Fun
anyone
fact.
who, yeah, that is a fun fact. That's cool.
Yeah.
The third piece I have is a quick one on food inflation numbers. It's a tweet from Hedgeye. It says how food inflation is crushing consumers. It's hard to believe, but the average price per unit in U.S. food manufacturing has surged a staggering 30% since the pandemic. Since the pandemic, that's the important piece there to think about that percentage. 2020, we're not talking about 1 year here.
Correct, sir.
Hedgeye's consumer staples analyst Daniel Boise, sorry about that, explained in careful detail how inflation is affecting food prices and adding pressure on consumers this morning on the Macro Show. I watched a little clip. It's a minute, 2 minutes long.
Yep.
And the point that he made was that while food at home CPI has increased about 1% over the last 5 months thus far. It's far from what consumers are really feeling. The politicians want you to focus on the 1%, but the fact is that it's up 30%, which is a big kind of piece of that core inflation that we're trying to kind of push down, of course. And you know, I put this in there just in case listeners are like, man, they keep talking about inflation going down, but it seems like food prices are, they've been high and they're not going down. And that's the problem with consumer staples and food prices when inflation hits is, typically the prices don't fall very much, particularly when you're talking about staples like, eggs and milk. When they go up 30%, they're not going to go down 30%. It happens, of
Yeah.
course. But typically, it's only going to happen whenever the market or whenever I should say the economy is under intense pressure. I mean, think like COVID, the Great Depression, et cetera, et cetera. So,
Yeah.
the consumers will feel this in their wallet a little bit more, and that's it's not in your head, basically,
No, I
if you're
mean,
thinking that.
I'm going to give you just a real life example. My wife and I have 3 kids. When she picks up Chick-fil-A from the drive-through for all 5 of us, that ticket's $48.
Yeah,
$48
yeah, I believe
for
it.
a
Yeah,
Chick-fil-A lunch for 5 people,
yeah, I believe it.
you know?
Yeah,
And that's hurting the demand side of the equation, right?
yeah,
And if you think about the average fast food restaurant, they're having to compete for workers. They're paying up for these workers. Their raw cost. I mean, everything that goes to that store is transported by diesel fuel.
hmm
They definitely have some structural issues, which is making these prices high. And I
yeah.
argue with you that they're probably not going to come down.
Yeah, yeah. One of the charts that Daniel talked about in the video that I watched was actually frozen foods and how frozen foods have really the bulk of the the pressure on price increase on the inflation side of things, and so that's going to impact the supply chain of fast food, right?
Yep.
McDonald's, Burger King, all of those, which prices have obviously gone up for pretty much all the chains. And it's because of that, the inflation on the frozen foods and just the food in
Exactly.
general. And obviously they're buying in bulk, but what they buy in bulk when that goes up, it's got to get disseminated somehow. And like you pointed out with the workers and fuel and et cetera, it stacks up and then it gets passed off to the end consumer. So it is unfortunate,
Yep.
but something to be aware of this year when you're doing your budget. Don't forget to increase your budget for food because
Yep.
it's not going to go down most likely.
Well, the other
So
thing they're doing, Nick, is it's being coined shrinkflation. So what they're doing is they're comparing the size of the patty, the bun, at like McDonald's 5 years ago to the size of the patty on the bun now, and the size of that meat's less. The bun's a little smaller.
yeah,
They're doing the typical shrinkflation. You compare to like what P&G and Kimberly Clark do. Instead of the tub of detergent having
yeah,
56 ounces of the detergent, it's now 52, that type
yeah.
of
They
stuff.
start cutting fluid ounces out of
But
toothpaste.
the prices didn't move much, right?
Yeah, the prices went up, but you
The
got
only thing I
two
can
ounces
think of
less.
in
Yeah.
my world that we buy that has not gone down in price is liquor. If you think about it, it's the only thing that has not seen the inflation front.
I haven't checked in on this, but how's the Costco hot dog Pepsi deal? Is
They
that
haven't
still
moved
good?
it. The, the,
They
the, the
haven't
hot
moved
dog's
it?
still $1.50. And when they reported
Right.
earnings recently, the CEO said, we're still not changing the price of that hot dog.
Awesome.
Love it.
Awesome.
All right, I'm going
That
to
that's not a,
transit
that's not a recommendation for or against
down for
Costco.
or
Yeah.
against Costco. Yes, it is not. Thank you, Nick.
Mhm.
All right, this is going to be a fun topic. This is going to take me several minutes to go over. Nick, let's make this interactive. If you think of a valid point or something you want to make sure our listeners and viewers understand when I'm going through this, please interrupt me. I want to make sure this is as thorough as possible. Okay,
Absolutely.
so let's begin. Education about the Dow and the S&P 500 index. You hear about these all the time in the news, right? So I saw this piece from Bespoke Investment Group on May 29th. And Nick, it got me thinking about the Dow Jones Industrial Index components and how most investors are uneducated on the topic. So I'm going to bring some things to light that I think most individuals have no clue about. And we're going to start with how is the Dow currently made up? And when I'm going to reference the Dow in this conversation, I am specifically referencing the Dow Jones Industrial Index that you see on the news. So my first point is as follows. The Dow is a share price weighted index. The S&P 500 index is a market cap weighted index. So let's do some education. A market cap weighted index, like the S&P 500, gives more importance to companies with a higher total market value, i.e., market capitalization, which is the stock price times the number of shares outstanding. This means that big companies like Apple and Microsoft, Nvidia we talked about earlier, have a bigger impact on the index's performance. On the other hand, a share price weighted index, like the Dow, is based on stock prices of the company. Here, companies with a higher stock price influence the index more, regardless of their overall market size. So, in the Dow, a company with a high stock price but fewer shares can affect the index more than a company with a low stock price but more shares. So, now let's look at a chart that caught my eye from Bespoke Investment Group on May 29th. Jenna's going to put up this chart for our YouTube viewers. I will verbally reference this for our traditional podcast listeners, but it will be in our show notes. And what you're going to see is that this piece of research that was submitted by Bespoke on May 29th, it's going to show you all the Dow 30 components. And what it's going to show you is the highest weighted names. I'm going to yell out the first three. So United Healthcare Group was at the time $503 a share. It makes up the largest weighting at 8.52%. Goldman Sachs is number two, $459 per share. It makes up 7.77% of the index. And then Microsoft, $430 a share, makes up 7.28%. So a couple of things I want to highlight here, okay? When you look at this listing, you have the bottom couple of names. Intel at $31 a share is only 0.53% of the index. Verizon at $39 a share is only 0.67. So what does this mean, listeners and viewers? This means that the top 5 names of the Dow make up 34.99% weighting in the index. The top 10 of the Dow 30 make up 57.51% of the index, while the bottom 5 make up 4%, 4.01 as of this date, and the bottom 10 only make up 12.2. Now let's pivot. According to S&P Global, the S&P 500 index is made up of 503 names. The largest market capitalization is over $3 trillion, and the smallest market capitalization is around $6.5 billion. The top 5 names with the highest market capitalization make up 28.07% of the index. This is all as of the market close on May 28th. And the top 10 names with the highest market capitalization make up 34.52. And the bottom 5 make up 5 basis points. The bottom 10, Nick, make up 13 basis points. That's 0.13%. Ready for this? The bottom 50 in the S&P 500 make up less than 1%. The bottom 100 only make up 2.36. And you ready for this? The bottom 200 only make up 6.68% of the S&P 500. So price per share doesn't matter for the S&P, just market capitalization. Why for the Dow? Market capitalization doesn't matter, just the price of your shares. So the next thing I'd like to show is kind of a heat map that I like to follow. This is one that you can get off of the website finviz.com, and it's free to access the site, and it shows you a heat map. But what I like about this, and this will be up for our YouTube viewers, this will be in our show notes, it shows you the market capitalization by size in the S&P 500. So you can kind of visually see the size of these companies. And again, this is from...
And by sector.
And by sector. Thank you, Nick. So you can see how much does technology make up? But the point I want to make here, and this is where I've been educating you with all facts. Now I'm transitioning to my opinion. My opinion is that the relevancy of the Dow is not what it used to be. And let me tell you why. This is my opinion. I look at what I would call the sensationalism of headlines. And let's just face reality, folks. It's not sexy to sit there and say that the Dow was up 0.5% or down 0.5%. It's sexy and eye-catching to say the Dow was up 500 points. The Dow was down
Yeah.
700 points. Okay? That's what gets people
Yeah.
listening. And the issue that I have with the Dow is the relevancy to what's going on in the American economy. Doing these things by share prices, in my opinion, is not a relevant way to do this. Now, we track it on our Independent Advisors podcast because our listeners and viewers do, because the general media does.
Yeah, because it's part of the
But
mainstream media.
part of the
So
mainstream
we're gonna
media.
track it.
So that is kind of my personal thoughts on the topic. You can probably read between the lines. I'm not as hot on this. Nick, what's your unfiltered thoughts and opinions on this?
Yeah. So one of the issues with the Dow, and you've hit on this, is again just the general idea of it being price weighted. Well, what happens with stock splits, right? That drastically changes the indice. Um, the other big issue with the Dow is that it is not all inclusive to all sectors. There's a little
Well
bit of
said.
favoritism, I guess you could say, to certain types of companies. So I think of the Dow, I think of blue chip companies, right? Which is a colloquial or I guess a jargon term for kind of well-known household companies, Coca-Cola, Microsoft, P&G, and the healthcare side of things, United Healthcare, for example. Um, their criteria is blue chip company, excellent reputation, sustainable growth, wide investor interest, and contributes to sector balance. So they do try to find sector balance. The issue is most of the world is looking and benchmarking to the S&P 500. Well, the S&P 500 is, as you can see from that heat map, dominated by technology names because of the market cap. So there's just a noticeable lack of technology names in the Dow, which I think is a reflection of the history of the Dow. And like you
Well
said,
said.
there's the
Well
history
said.
of the 500 points, and the Dow was more important 50 years ago because technology wasn't as important and wasn't as dominant of a player in the market, right? So the Dow was covering the dominant players in the market 50 years ago, now, not as much, which is why today's podcast, for example, you can really see that stark difference in the performance year to date between the S&P 500 and the Nasdaq and the Dow of almost 10% difference. It's because they have a smaller selection, and I'm okay with a smaller selection of tickers.
I am too.
I think the combination of the share price weighting and the lack of exposure to true growth areas in the market that I guess maybe historically were much more speculative, 20 years ago for the Dow. I think that's where the indice is kind of missing, personally.
I have a way to view this from my lens of the world that I think the listeners and viewers would love to hear. Could you imagine if you and I were talking to a prospective client of the firm and they're like, talk to me about your security selection, how you pick names. And let's say you were in the room and you kind of go through our methodology. And then they say to you, well, how do you then do your portfolio weights? And you look at them and say, oh, we weight it by share price. How do you think that conversation would go?
Yeah. Yeah, that's a great point.
They would
That's a
sit there and
great
say,
way to
did
think
your
about it.
did your 9-year-old pick that methodology?
Yeah, that is an excellent point because that is I would never do that.
You'd never say that in a client meeting. You would never manage money in that way.
Yeah,
I'm just,
no,
I
yeah,
know that's the way I view it from that lens. You get laughed
yeah,
out of the room.
yeah, absolutely.
Okay.
Yeah, yeah, that's a very funny way to think about it. But yeah, it's like common sense. You would never, you would
Would
never
never
do
do that.
that.
So I think
Yeah,
this is a good piece for our listeners and viewers. Again, I want to reference it because the larger mainstream media does. Personally, I think the S&P is more relevant than the Dow because of what we discussed, because it's market cap weighted. NASDAQ definitely has its spot. It's going to be a lot more tech heavy finance, biotechnology, just what that index is known for. And it's nice to get the comparison that we do at the beginning of the podcast, looking at the world ex-United States. And that comes with its own kind of weightings and what you see in other countries. So for today's topic, let's put that to a close, Nick. I think it was good education for our listeners and viewers. It's always fun to share our raw thoughts. I like to separate fact and opinion. I think you and I did a good job of disseminating those two topics. My next piece you've already covered. To give some proper credit, I caught this piece from Seth Golden, a regular on the Independent Advisors podcast, not only as a guest, but us referencing his material. And he also caught that piece from Goldman. All right, finishing up, we do have a listener question this week. As a reminder, listeners, you can email us at inquiries@jessupwealthmanagement.com. Feel free to send your questions and we will address them on the podcast. Mr. Whitaker, this week we have a question from a regular listener by the name of Tim. Tim says, hey, travel and leisure stocks, specifically cruise names, they haven't recovered much since the pandemic, yet the industry is booming. What the heck is going on here? Nick, your thoughts?
Yeah, it's a great question, Tim. Thanks for sending in the question. We love these.
They're fun.
To me, what this gets down to is capital discipline and capital efficiency and cash flow. So the balance sheets. Yeah, you're right. The consumer spending and I would say generally, there's been a recovery in the industry. The concern is for that to translate into bottom line performance. And when you take on a lot of debt and COVID, sometimes it can take a while to kind of churn those profits through. So that's my general take on it. Matt, do you want to add anything there?
Yeah, I mean, I want to overlay that on, and this is my opinion. My opinion is Wall Street's been well underestimating the resilience of the American consumer. And so they are going to continue, in my opinion, to underweight that. At some point, they're going to be right. A broken clock is right twice a day. And at some point, they're going to nail it and say, see, I told you. And but they're not going to tell you on all the gains they missed out on by the time they end up being right. Having said that, I also think that there is concerns in the investment community because there's a lot of opportunities right now in the market. What happens if another pandemic comes along, right?
Yeah.
They're already saddled with a bunch of debt. You're hearing the rumblings of things like bird flu. Who knows what's going to come to fruition on that side? I just think that you have a lot of capital who's like, I have a higher confidence in other areas, which is affecting the valuations on these stocks, what people are willing to pay for them. So I think it's a cross current. I think I would give more weight to what you said as the predominant factor and to a lesser extent what I said. So Tim, I hope that gives you a little bit of an idea what's going on. I also will say there's been a lot of capacity, I feel, that's been added over the last decade. And so even though it's booming, they got a lot of cruise ships to fill.
A lot of competition.
Yeah.
So that risk reward kind of opportunity cost of where we are in the cycle and the risk of betting on the consumer at this point with rates high and we're kind of waiting for unemployment to go up, right? It's like plus the capital efficiency. It's it's like you could do that or you could put money in the AI trade. Clearly the market has decided to go the AI trade. So I think that the risk reward opportunity cost that you're kind of talking about is a great point as well.
I got a hot take on this topic.
All right. Love a hot take.
You ready for a hot take?
Always.
Hot take is I could see the pendulum moving to where if there starts to be excess capacity at some point, they'll start converting these things into some sort of apartments where people move on them and these things are constantly moving. You're already starting to see some of these cruise ships turn into condos with a HOA type of fee that they pay ongoing. And I'm just going to throw it out there. I think you're eventually going to see people be like, yeah, instead of me having my second home in Florida or the Carolinas or in Arizona, I own a 2-bedroom on this ship, and I'll just catch up with it throughout the year when I want to. Hot take, I see it coming.
That's a great point. I definitely can see it coming. I say because there's no way I could do it.
I hear you. But
1
there's
week on a
people
cruise
out there
ship is
that love
enough
to
for me.
cruise. Love
Yeah.
to
Oh
cruise.
yeah. I mean, yeah, there's certainly demand for it. To each their own. There's not enough Dramamine for me to do. So,
I love it. Well, a couple things to finish up our listeners and viewers, and I'll get your final thoughts on the sign off. First is we use Blueberry for our podcast hosting, very popular hosting. If you want to create your own podcast on Blueberry, that's BLUBRRY, use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month with promo code Jessup Wealth. That's all lower spaces. In addition, if you're looking for a good piece of AI software to help you note, take, summarize a meeting, plan your action, needed tasks, we highly recommend Firefly's AI software. We can use the link in our show notes below to purchase your subscription, make life a little bit easier. We use it to summarize our podcast notes for our listeners and viewers. So before we sign off on episode 255, Mr. Whitaker, closing thoughts.
yeah, I'll just say thanks again, Tim, for the question, and hope listeners enjoyed it. Hope you guys have a nice weekend.
Got that jobs number tomorrow. Pay attention,
That's
everyone.
right.
We'll see you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.